you and your colleagues slightly lifted the longer run estimate, the neutral funds rate estimate, to 3%, but that's still, I believe, like 125 basis points below where it was 6 years ago. What are the odds that productivity, investment, productivity, labor market, other developments could further push up the longer run estimate and possibly make the projected funds rate levels less restrictive than they now seem?
So in principle, these starred variables, the long-run growth rate of the economy, the neutral rate of interest, the natural rate of unemployment, don't move quickly. They move very gradually. They're pinned down by longer-run forces like demographics. In the case of the funds rate, it's productivity, it's appetite for safe assets, and demographics and other things too. So they move quite slowly through time. I think we all look at them. Those of us who file SEPs every quarter will look at that every quarter and not make a change every quarter, but every now and again make a change. And you're right. We actually, the median ticked up a tenth. It's a tenth we're talking about here. So, but still, I think it's a positive thing that people could be raising their estimates of the longer run neutral rate and potentially the longer run growth rate. Who knows? And maybe reducing their level of the natural rate of unemployment, which has been the trend. It's just that you change those estimates over time. They're informed by incoming data. They don't change a lot, though. Although they did, it's interesting that the neutral rate changed quite sharply after the financial crisis in many different models, and it's been slow to recover. I don't expect a dramatic recovery there, but we're so bad at forecasting productivity. It's just very hard to know when productivity is going to arrive and in what quantity. So I think we have to be humble about how little we really know about where these starred variables either are or are going.
Paul and then Jean.
Hi, Chairman. Paul Kiernan from Dow Jones Newswires. Thank you for taking the question. I'd like to just kind of ask again, you mentioned earlier that a gradual pace of rate increases will make it easier to react. But specifically, what are you looking to see? Because you've also mentioned, that monetary policy operates with a lag. So any kind of specific signposts that maybe we've reached the end of the tightening cycle or where we should stop? Secondly, if you worry about the divergence between interest rates in the U.S. and internationally, especially at a time when emerging markets are under pressure. Thanks.
Sure. So, some of the things that we'd be looking at to tell us whether we're getting close to supply-side limits would be, first, does job growth slow down? A slowing down in job growth would be an indicator. An unexpectedly sharp increase in wages or inflation could tell you that you're reaching those points. If headline growth slowed down, that's another one. So all of those things would be worth taking into consideration. I think also, though, we've seen sometimes sharp tightening in financial conditions, as we saw at the beginning of 2016, can have a substantial effect pretty quickly on our economy if it's a broad and significant tightening. So we would be looking for those kinds of things and many other things. So in terms of divergence, yes. So the U.S. economy is, as I mentioned, is strong and is at a pretty positive moment, with strong growth, healthy labor market, inflation right on target, as I mentioned. So we've seen growth abroad, but growth, I think, both in advanced economies and in some emerging economies has slowed down a little bit. And in that world, if the U.S. is stronger, then that's just part of the context, part of the environment. That could mean a higher dollar. It could therefore mean that some of our demand will wind up being shared with other economies. That's the way the integrated international economy works. So you could see that, and it's just all of those are all things that go into thinking about the path of the economy. I would say, we're not responsible for the dollar. Of course, the Treasury is responsible for managing the dollar, but The dollar has only partly recovered the decline that it had in 2017. It's moved up off its lows, but it's not as high as it was at the beginning of last year yet by a significant margin.